Okay, good afternoon, everybody, and thanks very, very much for joining Ricky and I on today's webinar, which is all about securing the best funding options for your SME in a high interest rate environment. I'm Adam, I'm one of the directors of Fusion, and I'm delighted to be joined today by Ricky from Plexus Finance. We're just going to wait a minute just for a couple more people to join, and then we're going to get started. We'll start in literally about 30 seconds. But yeah, really pleased to be doing this webinar with Ricky today on a subject that's becoming increasingly important for most of our clients and prospects we're speaking to, whether they're trying to raise money for acquisitions or cash flow or any other kind of business requirement, really. So really pleased to be doing this with Ricky today. Okay, I can see a couple more people joining, so let's make a start. So if we can just do a couple of introductions. Ricky, do you want to just introduce yourself?
Yeah, sure. Thank you firstly for having me, Adam. I'm Ricky. I run Plexus Finance. We're a debt advisory firm based in London. We help businesses across the UK with a full suite of SME lending products, from working capital to business loans, asset finance, M&A finance, and everything in between. So yeah, delighted to be joining today.
Brilliant, thank you. And for those of you who don't know me, I'm Adam Maurice, one of the directors of Fusion Consulting Group. We're a multidisciplinary consulting practice covering entrepreneurs, private clients, and fast growth businesses around tax, accounting, financial services, legal, recruitment, and business advisory. Okay, we've got a jam-packed agenda today. Ricky and I are going to be talking through the current state of the market, which options for funding are right for your business, things to consider when refinancing, tips on how to get the best funding for your business, and we're going to cover off a couple of case studies that Ricky's been working on, and lastly finish up talking a little bit around how Plexus and Fusion work together and how we could potentially help you guys. And we're going to leave a little bit of time at the end for a Q&A session if anyone's got any questions. So just on that, there's a chat function on the right hand side. If you want to put any questions in there, we'll pick those up at the end. But obviously, very delighted to have a kind of follow-up consultation, either Ricky or I, with anyone that's joined on the webinar today. So, Ricky, I'm going to hand over to you if that's all right. Take it away.
Fine, great. So, I wanted to firstly just start with a quote just around the COVID loan schemes, because they were well documented at the time, and almost 80 billion was lent on those schemes during the pandemic. And if you look below that quote, you can see that there were quite high default rates for those schemes. And I think it's just a poignant reminder of the stress that it's caused within the market. And when we go on to discuss the current state of the market, it's really against the backdrop of that particular scheme. Unprecedented amounts of funding were lent. Businesses were well capitalized, and it has created, I guess, some of the challenges that we maybe face today. So if we go on to the current state of the market, I mean, the clear and obvious change in the market is that increase in interest rates, well documented, well publicized, impacting people not just in business but personally, with mortgage rates. And base rate going, from 0.1% during the pandemic up to a base rate of 5.25% is, of course, going to have a really big impact on the cost of funding. And what we're seeing as a trend, especially in unsecured lending and term loans, is that there is a lot more focus on shorter term debt as a result of the increase in rates. Uncertainty means that less borrowers want to lock in funding for longer, and also they typically, when the rates increase, the stress that it takes on affordability increases. So shorter term debt options are more prominent. Lenders now taking more security. Again, one of the headline terms of the C-bills and bounce back loans was that there was no personal guarantees, no brick and mortar security. That is certainly not the case now. We're seeing lenders, especially in high street banks and more specialized lenders, taking either brick and mortar security, debentures or personal guarantees. I think it's key to note that the default rates that were extremely high in those COVID loans has certainly had an impact on lenders underwriting, and credit assessments. They are certainly being far more careful when they're looking at businesses, and a lot of those businesses have quite significant debt in place as well. So it is putting more pressure on affordability tests, because when you're looking at businesses that already have to service debt, it leaves less free cash to service additional debt.
Makes sense. Do you think that there's still the appetite at the high street to lend? I mean, from what you're seeing, or is it more specialist now?
Yeah, I would listen. There's the banks are certainly still lending, but I would say more on securitized debt. So, commercial mortgages, asset-based lending, absolutely. But, for working capital, we're seeing far less appetite. And that's where those specialist lenders are certainly, picking up the slack of the high street banks. So we'll move into, the options available. And there are more options than these four, but I wanted to pinpoint these four options because I'm getting a lot of requests from existing and new clients with regards to, I would say, term loans, working capital, asset finance, and then tax funding. So I'll talk quickly just around each of these financial products. We can go into detail later in a Q&A if anyone's got any specific questions. But just to discuss term loans to start with, typically it's an immediate cash injection into a business, and then that debt amortizes typically over 6 to 72 months. So it can be short term, or it can be spread over 5 or 6 years. It amortizes, as I say, over the term, so you're paying back capital and interest over the term of that facility. And again, term loans are great where there's either capital expenditure or there's growth in the business. Maybe you need to employ new staff, buy stock, start a new project. It's great for growth because if the business is growing, then it's going to be easier to service that debt, and you're using that funding, and there's a clear return on that investment. Invoice finance is a great working capital tool. It revolves, and that's, I think, the key differentiator between a term loan that is an immediate cash injection versus something like invoice finance that revolves and effectively replenishes. And that's also great for growth, but also good for working capital. So invoice finance, if you're not familiar with it, is a tool which allows you to get paid on your trade receivables quicker. So a lot of business-to-business businesses will get paid on terms by their clients, typically 30, 60, or even 90 days in some cases. That can cause incredible stress on a business's working capital. So invoice finance effectively allows you to get paid on those invoices at the point that they are delivered or completed upon. And if you're growing, that facility can grow with you. But ultimately, when those invoices are paid, that facility replenishes, and then you can use it again. Asset finance, maybe the most self-explanatory, is used for purchase of assets, either plant, machinery, vehicles. It's typically a bit more competitive in terms of rates because it's securitized against a physical asset, and it's great if you're buying again new plant, machinery, vehicles, whatever it might be, as long as it's for business use. It's a great tool to spread the cost of those assets over, a longer period of time to help either your working capital or your cash flow. Finally, and something that's becoming a bit more prominent is tax funding. So what we've seen over the last few years, especially since the pandemic, is more businesses taking time to pay arrangements with HMRC, or struggling to repay VAT, PAYE, or corporation tax. We do work with some lenders that will effectively pay your VAT, PAYE, or corp tax on your behalf, and then split that payment over 1 to 12 months. It's been a really effective tool for some businesses that understand that HMRC are a key creditor and have to be paid. And businesses do not want HMRC breathing down their neck. But also for some businesses that, for example, are cash accounting, and Adam, I'm sure, can attest to this, they might have to pay their VAT before they're paid by their clients. So it's important to manage your cash and make sure that you can repay HMRC. So yeah, this particular tool is great if you want to spread the cost of HMRC payment.
Another thing on that, Ricky, which is quite important, is that HMRC have recently started charging 2% penalties on outstanding amounts. So again, looking at that 2%, especially as that figure may grow if the VAT or corporation tax PAYE is not paid, spreading that payment over 12 months, you may not get a time to pay arrangement anymore with HMRC. So it's very important that if that is unavailable, or even if it is available, it may not be the right thing for your business, to look at other options such as these. We have a few clients who've been using these types of products and have been very happy with it. So very good.
No, that's a really good point. Yeah, and absolutely, we're finding this has certainly been a far more popular product that our clients are asking more and more about. So moving on, and again, this, I guess this probably is more associated with term loans and asset finance, but also invoice finance. But another request we get from our clients is refinancing. Refinancing can be really challenging, especially where people have businesses have taken funding 2 or 3 years ago at much lower rates. The challenge is that you're almost certainly not going to be able to secure the same rates you did 2 or 3 years ago. So, what should you consider when refinancing? And really, it's about why you're looking to refinance. What's the ultimate goal? Is it to reduce your cost, or is it to reduce your monthly outgoings? I think if it's the latter, refinancing and putting refinancing your debt onto a longer term can be really beneficial for your business if you're struggling to repay debt on maybe shorter amortizing profiles. Refinancing can reduce those monthly repayments, but also maybe you can reduce the cost potentially, but also maybe you can increase the amount of debt and inject further debt into the business, but still keep your monthly repayments lower. So an example, I had a client that had a CBILS loan. The first year was interest only. So actually the amortizing profile of that particular loan was over 2 years. So, £100,000, refinancing that over 5 years saved my client several £1,000s a month. Not saved, but certainly reduced the monthly repayments by several £1,000s a month. And that gave them the breathing space they needed to push on with the business. So you need to look at what the overall impact is, and also how it will impact your future debt raising capabilities. Again, we're finding that we have a number of businesses that are growing and taking debt out, which then in turn gives them problems raising debt further down the line. So refinancing, two or three facilities onto one, lower monthly repayment facility might actually work better for you in the future as well when you're looking to raise further debt. So moving on to 3 tips on securing the best funding, I would always suggest to all clients that always start with why. And it probably seems a bit ridiculous, really, why am I funding? Why am I looking for funding? But when I say that, what do you actually need the money for? Is it, if it's working capital, break that down. What does that actually look like? And make sure you're tailoring the solution to that need and not the other way around. And so often I see, people, business owners coming to me and saying, look, I need 50 grand for working capital. And you go, okay, but, what does that actually look like? Is that, paying suppliers? Is that, paying staff? Because sometimes there might be a better solution for that particular problem. For example, if you're looking at, actually, I really need to pay my suppliers. Well, okay, is there a way that actually you could maybe increase the cost of those goods by 1 or 2% and extend the terms? Is there other ways, or can you use supplier finance instead? A loan or asset finance or whatever it might be might not necessarily be the best option. So again, you need to really look at why you're looking at funding, and if it's for working capital, what does that actually look like, and make sure you're tailoring that solution to your need. And within that, looking at the return on the investment. Again, that's probably more if you're growing, what is that funding actually going to be used for, and what is the return on investment of that particular funding facility. Again, the second one probably seems very obvious and it ties into the first point, but have a detailed plan. And again, I can't tell you the amount of times a client will come to me and say they need money and not give me a breakdown of where the funds will be used. And lenders aren't just lending to your business, they're effectively investing in you and your business. So if you don't have a detailed plan, it's going to be very difficult to convince that lender to give you the money if you don't know yourself where the funds are being used. And it's a really useful exercise as well to ensure that you're not raising additional capital that you didn't need to, because ultimately, if you only need £30,000 and you're putting in an application for £50,000 because you need £20,000 of breathing space, well, have you done a cash flow forecast, for example? Do you know for sure that you actually need that breathing space? Planning ahead can really help you see those working capital holes. And as we go on to the third point, which is work with the experts, working with your accountant is so important with this, because they will have a great insight into your business, into your cash flow, to determine whether or not you need the funding that you're actually applying for. So the third one, as I say, is working with the experts. When we look at so many products, mortgages, I wouldn't go to the market and try and find a mortgage. I'd go to a mortgage broker. I wouldn't, try and do my own tax return. I'd go to an accountant. It shouldn't be any different with this. You want to spend as much time as you can running your own business, and ultimately, leave raising funding to the experts, because they see the rates, they see the market, they know it day in, day out, and your accountant as well can help prepare the necessary information you need to ensure that your application is successful.
I think, Ricky, that's a very good point. I mean, I think that people are probably more aware of this on the kind of personal mortgage side, but packaging up, certainly in my experience, packaging up a finance application which has been put together by a finance company has got a much greater chance of success than trying to put together something of your own. I've seen that with high street banks, specialist lenders. The way that an application is packaged together, the way that the finances are prepared and explained, is really important. I think, Ricky, it's still the case that a lot of these kind of underwriters now are going into a lot more detail on these types of applications than they ever were. It's not just a yes, no. They've got to really understand the business, don't they?
Absolutely. And again, that goes down to that detailed plan. They are, a lender is not just looking at your last set of filed accounts and making a decision. They're looking at, bank statements. They're looking at the conduct there. They're looking at your management accounts. They're looking at your balance sheet. There are so many factors that go into underwriting a deal. And you've got to remember, these lenders they're not lending, hundreds of pounds. They're lending tens or hundreds of thousands of pounds. So, to put an application in with minimal information ultimately gives the lender a reason to say no. And unfortunately, in this current state, that we find the market in, more lenders are looking for reasons to say no. So working with, whether it's a broker or an accountant, to put applications together can really increase your chances of not only finding the finance, but finding the finance at a more competitive rate.
Makes sense.
moving on to case studies, and the first one here. So, this is a client of mine that was a fast-growing distribution company struggling with long payment terms. And initially, they approached me for a loan, and when we looked at their debtor ledger, I could see that actually a lot of their clients, when we say they're paying on long payment terms, they're paying on 60 days on average. But they had a ledger of £400,000, and to buy more stock, they wanted £150,000. But actually, when looking at their ledger, looking at the business itself, it was well suited to an invoice finance facility. In doing so, we structured that facility that gave them 85% of their ledger day one, but also at a lower cost to my client. And because that facility revolves, they're effectively receiving the money from their ledger effectively every 45 to 60 days. So the funding requirement that they suggested they needed of £150,000, well, actually, they needed a lot more, but they were looking at it quite short term. So with the invoice finance facility, they're effectively, they're funding their business on a revolving basis, but they're injecting, almost £2 million of capital into the business over the year. So, that was a great solution, and really helped their business. And especially as they were growing, that facility has been growing with them. So again, we touched on refinancing and this particular business. I think, they came to me and they were looking at refinancing two CBILS loans, one short-term loan. It was about just under £220,000 outstanding. Again, they suffered slightly from the CBILS loan because the way they amortize is over a shorter period than they were documented. If you took out a 5-year loan, you were typically, if it was with one of the unsecured lenders, paying it back over 4 years. And one short-term loan that had really high repayments. The solution there was just refinancing, the 3 loans into one and increasing the repayment profile to 5 years. In doing so, we reduced the monthly repayments by over £3,500 a month, and that certainly helped ease their working capital pressures. But one of the challenges is that with those CBILS loans, those two particularly were on lower rates, but that short-term loan was on a higher rate. So actually, when you when you take the average across the 3, we were still actually able to, give them not parity, but certainly close to parity with the rates they're paying across those 3. So, it's just important to, when you're looking at your facilities, consider all the options and consider all the costs as well. Because actually, even though maybe 2 of your loans might be on really low rates, when you package them all up, you might find that actually the rate across the 3 is not too dissimilar. And then finally, we have a client of mine that was growing really quickly and looking to acquire a competitor. And this competitor was effectively a retirement sale. So, the client had been pursuing this acquisition for a while. It gave them a really good opportunity to increase their client base, but also add revenue and profit to their bottom line. And they'd structured a deal where they needed £350,000 as the first payment. We were able to effectively structure a term loan against the target, so the acquisition balance sheet, to raise that £350,000. In doing so, we were able to facilitate that purchase, and that my client's now taken over that competitor and is continuing to grow. It's important, again, when we're looking at the M&A market, to look at not only the strength of the business that's buying the competitor, but that competitor as well. And if you're able to leverage the balance sheet of that business, it can prove a really not only cost-effective solution, but a quick one too. The challenge here, again, and when it comes to the M&A market, is most lenders will require forecasting. They'll need a model, and we were able to work with Fusion actually on that one to help with the modelling and yeah, they were able to help us get the deal over the line. Is there anything you want to add on that?
No, that was a really, really good outcome for the client. They initially didn't feel that they'd be able to get the money together, but yeah, that was a great example of where we were able to work together, Fusion and Plexus together to get that deal over the line. So yeah, we were very pleased with that, as was the client. And it's about, I guess, coming up with these kind of creative solutions. Their balance sheet of the client, wasn't strong enough to support that loan. But when we looked at it together and we said, well, okay, this is what the target balance sheet is going to look like and the forecast, we were able to get that past credit. So yeah, very, very interesting, these kind of M&A deals. But we'll talk about that again in a couple of slides time. But yeah, very, very good case study there of where we were able to get something done together.
Yeah, no, great.
Do you want to talk a little bit about Plexus? I know we've talked about the products and everything, but just about how you work and yeah.
Yeah, absolutely. Yeah. So as I mentioned at the beginning, we're based in London, and we're debt advisors. We specialize in business and property finance, and within that, we do corporate finance and M&A. We focus on UK businesses, but we're sector agnostic. So we will help any UK business. Yeah, obviously there's certain products which lend themselves to business style businesses, but yeah, we will help any type of business. And our approach and our goal is to try and secure the best possible finance for our businesses. And the way we work typically is, we would sit down with our clients, either new or existing, and we'd have a preliminary discussion to understand exactly what their requirements are. We then go into a review of the business, which we conduct in-house, and we then go out to the market and look for the best options before presenting them to our clients. Our panel of lenders includes high street banks, debt funds, specialist lenders, property lenders. We have well over 100 on our panel, and we've raised over 65 million in debt for UK SMEs to date. So yeah, that's
brilliant. That's really, really good. Thank you very much. Okay, so I'm just going to talk a little bit about Fusion just to kind of finish off before we go to Q&A. So we're a mid-tier multidisciplinary professional service group. We're helping entrepreneurs, fast growth businesses achieve their ambitions through what we call 360-degree advisory. So as I mentioned, we cover tax, legal, accountancy, financial services, recruitment, and business advisory. There's about 90 of us. We're based in London, Hatfield, Surrey, and South Africa. And we're really trying to disrupt the professional services space by offering this 360-degree advice, all your advisors, all under one roof, giving you access to a whole wide range of skills and experiences for everything across the business journey, really. We do a lot of corporate finance. We've worked very closely with Ricky and Plexus on the last few deals, and very, very happy to recommend Ricky on any kind of debt situation. Very, very knowledgeable, very, very pleased to be working with him. So I think, from that point of view, we, especially as I said on the corporate finance side, some of you who are watching are probably aware, within Fusion, we've actually acquired a number of businesses this year, fully debt financed. And so, we really understand what options are available. We've worked very closely with Ricky, and very happy to speak to any of you today, just around kind of what we've been doing around our debt financing and how that's going to help us hopefully complete the next 5 to 10 acquisitions over the next couple of years. On the Fusion side, we're all entrepreneurs. A bit cheesy, but we feel we're built by entrepreneurs for entrepreneurs. We really do understand the buy and build market and what's needed to really achieve those types of successes. So very, very happy to speak to anyone on any of those topics. Just to cover off again, these are our skills that we have in house. It's quite far-ranging and far-reaching. And again, very happy to work with Ricky, with anyone on the webinar today to talk around how we can potentially help you in your business journey. So, as I mentioned, very, very happy to arrange consultations with anyone. Either drop Ricky or I an email, or give us a call. Our numbers and email are on the screen. I just want to say that obviously everyone's circumstances are different, and that's why it's really important to seek out specialists, and very bespoke advice depending on your circumstances. Ricky and I have both seen a tremendous amount of different businesses and business situations, both from a kind of everything's going great, we want to expand, to maybe everything's not going so great and we need a bit of help on the refinance, and everything in between. So, feel free, pick up the phone or drop us an email. We'll be very happy to arrange, absolutely no obligation, free of charge consultation to discuss any of your requirements. Okay, so now's the bit when we do a little bit of a Q&A. I can see we have got some questions that have been raised already, so I'll read them out and let's see where we go. So first question here. So we've got, what is the current situation with PGs? So I guess, Ricky, that's probably where you mentioned before about guarantees. They're still required, I guess, even more so now, no?
Yeah, look, so the answer to that is yes and no, and it depends on the financial product. So if we take term loans, there is the not so well documented RLS loan scheme, which followed CBILS and the Recovery Loan Scheme 1 and 2, and we're on to the third iteration of that scheme. Just if you're not aware, that gives lenders a government guarantee of 70% against loans up to £2 million. Under the CBILS and bounce back loan schemes, that government guarantee meant that any loans under £250,000 could not include a direct personal guarantee. But with this recovery loan scheme, that's not the case. In fact, some lenders that are offering the recovery loan scheme are still taking 100% personal guarantees. And the government guarantee only kicks in if they're unable to call upon the personal guarantee. So for term loans outside of the recovery loan scheme, absolutely, personal guarantees are being requested. For asset finance, it's less required. Again, it depends on your business circumstances, but certainly when it comes to asset finance, it's less required because there is security in the assets, but some lenders are still asking for that. And again, it depends on your business, the asset type, and the circumstances around that particular deal. But I would say for most financial products, yes, personal guarantees are still being requested on deals.
Okay, good. Thank you. Next question. What's the difference between financial modeling and financial forecasting?
So do you want to say that, or shall I?
No, go for it. Go
on. Fine. So, the key difference really is, when we talk about forecasting, we're talking about, the future of business, forecasting out, their cash flows and, their cash management. When we look at a model, that's again more used in M&A. And we're looking at modeling out the business and the repayment of debt over a certain period of time and looking at how the business is going to grow. Do you anything to add there, Adam?
No, that's absolutely right. Financial model can go to 25 tabs and counting. Absolutely agree with that. So another couple of questions here. Why shouldn't I speak to my high street bank?
You should speak to your high street bank. That should always be your first port of call. Absolutely. I think when it comes to your personal relationship that you have with your bank, if you do have a personal relationship with a bank manager,
does anyone have a personal relationship with their bank anymore? I'm not sure.
Yeah, less so, and I think that highlights probably the big issue with that. But look, ultimately, I think your bank should always be your first port of call. But what we're seeing is banks taking longer and longer to make decisions. And I would never suggest that you speak to your bank in isolation. I would always be looking at some other options alongside that.
I was about to say the same thing. I mean, you've got to have a couple of things going on at the same time because it is a very, much more difficult market than it ever was. I totally agree with that. Okay, so we've got one more question, which is, I have £700,000 of debtors. What could I borrow on invoice finance? Good question.
So, It's a good question, but it's not as straightforward as saying you could borrow X, because it's going to depend on a number of factors.
How old the debtors, what it is, assets.
Yeah, so firstly, creditworthiness. How creditworthy are your debtors? Are they blue chip, or are they mum and pop shops which have no credit rating? Is all that debt current, i.e. within terms? What's your concentration? Is that £700,000 worth of debt to one client? And then what kind of advance rate can you get on that debt? Well, that's going to depend on which sector you're in. So, for example, if it's a recruitment business doing temp recruitment and it's backed by timesheets, you're looking at 90% advance rate. But if it's a construction business that's taking their that's invoicing through applications and payment certificates, that could drop to between 40 and 60%.
Okay, last question here. So it says here, what is the typical timeline between start to finish?
Timeline of what? Sorry,
I guess timeline from kind of initial, like to get the money, to get the money, I guess.
Okay, well, I mean, if we're talking about, again, unsecured loans, I would say usually a couple of weeks. So that's from initial consultation. We have a discussion. You send your information for me to review. That takes typically 24 hours, maybe sometimes 48. There's a lot of information to review. I'd then go out to the market, which can take anywhere from 3 working days to 10 working days. Present the offers back to you, and then that's maybe another couple of days before funds are drawn, just to go through legals and draw down the funds. Invoice finance can take a bit longer because you need debtor surveys. There's more information that's required. So that can normally take 2 to 6 weeks from start to finish. Process is again very similar. We have a consultation. You send me the information. We go out to the market. Typically in invoice finance, lenders want to see the clients face to face. That's less so the case in asset finance and term loans against unsecured loans. And then really it's a lot of these things depend on how quickly you can get the information and respond to queries. So I'd say anywhere between 2 and 6 weeks.
And that was going to be my kind of follow-up question for those who maybe not picked that up. So what information would someone need to be able to send you to get the initial kind of ball moving? So
to get the ball rolling, typically we want to look at the last set of full unabbreviated filed accounts. So that includes, P&L, detailed P&L, balance sheet notes. We then want to see management accounts, 6 months business bank statements as well. So that's typically, for most facilities that we look at, that's the baseline information we need.
But you'll be able to give a view, like a broad view based on that information. You better give a view on whether something's possible or not.
Absolutely, and then there's again, when it's invoice finance, we're going to want to look at your up-to-date age debtor ledger and creditor ledgers. For larger facilities, we'll want to see financial forecasting. Again, for M&A, we want to see a detailed financial model, which demonstrates the business, of where it's heading and where its capabilities of repaying the debt as well.
Brilliant. I think that covers all the questions. That covers everything. Brilliant. All right. Well, listen, I just want to say thank you very much, Ricky, for joining me today. Hopefully that's been very informative to everyone. And listen, thank you very much for joining. Everybody who's joined today, you will get a copy of the webinar emailed to you. And again, our details are on the screen. If you want to give either of us a call or an email, we're very happy to arrange a absolutely free, no obligation consultation to chat through your situation and see if we can help. But yeah, Ricky, thanks again. Really appreciate you coming on today.
Thanks for having me. It's been a pleasure to talk to you today, and look forward to